definitely. There is still opportunities in short vol trading. As you mentioned, the risk premium has decreased, be it in volatility or other hidden parameters. The main reason, as you mentioned during the panel, was because you have a larger number of institutional clients now who are very active in that field. But we are still realized, even if we are changing regime, we're still in a low vol regime, meaning that there is still opportunity to sell volatility. If you look at Euro stocks vol, for instance, vol in Europe, you have the skew is very expensive to 3 months, 4 months space. Hence, actually, the volatility of the strikes that are 5%, 6% out of the money in those tenor is still reasonably expensive. So one actually can extract premium from selling those. One of the panelists mentioned a legacy. In Europe, we tend to trade everything tied. Okay, that's because since the beginning, Eurex actually offered us the capability, one of the exchanges actually offered us the capability to cross with Delta. And that has been a feature that has been here forever in Europe. In the US, actually, trading live has been the market standard. So it's just a matter of market standard. There is not one better than the other. What we tend to see that a client who are trading volatility as an asset tend to prefer it with the delta, so tight. Clients who actually are doing directional trade, most of the time actually execute two ways. Either they ask for the option naked and we trade with them naked, or what they can do is that they ask us the option to be tied, then we execute the delta, and then delta adjusts the option based on the level we got on the execution of the future hedge. So for me, there is not one that is better than the other. It's just it's two market standard, two different markets, and they trade differently. But at the end of the day, both actually deliver to the end user what he really likes and what he really needs to hedge his portfolio or to express his view. And for us, actually, it's very similar and the same. Obviously, we have been seeing in the last few years, a bigger integration between exotics business and flow business. The main reason for that is because, let's take the vanilla option. In the past, people who are using option and were selling, for instance, volatility, were hedge funds, were very sophisticated clients. Today, everybody actually is trading volatility as an asset class. Many more clients are doing that. Some of them are sophisticated, some of them are much less sophisticated. So to be able actually to go and tap into that client base, what we have some systematic strategies where you feel the biggest growth in AUM in the business is what we call QIS, which is quantitative investment strategies. Those one actually are systematic strategies and they are automatically delta hedge. Most of the time, because of the operational burden to be able actually to book those trade delta hedge systematically, those risks sit in exotics. But if you look at the trade itself, it's a vanilla risk. So actually the risk has to be managed by flow. So hence actually there is easily a bridge between those two. So it started like that. And on top of that, on the long dated part of the curve, you have the structured product, which give a lot of supply to the exotic desks that they need to recycle. And which place the best place to recycle risk? Flow, because it's the gateway, the access to the market. Hence, actually, the better integration between those two businesses give us a much bigger liquidity pot that we can offer to clients. So everybody actually benefit from that. The exotic desk because they're able to recycle their risk, us because actually generate flow, we have access that we can show to the client, and the client because actually they have a much better pricing because actually the desks are fully integrated between themselves. The reason why it helps in price discovery is because if we integrate the desk, the risk recycling, for instance, let's take the best example, is our exotic desk quotes on a structured product, autocall. Okay? They get delivered some risk. Some of that risk is very vanilla. The part of the risk is very exotic. For the very vanilla part of the risk, let's say the price discovery is already done, so we know where actually this is pricing, so that's easy. The one that is less easy is, for instance, some of the hidden parameters. For those having desks that are integrated, make sure that actually the pricing that the exotics desk will give on that structure will be consistent with the pricing coming from the vanilla vol surface. And I think that is key here because it allows the banks to be very comfortable in the price they give to the end user and in the risk management methodology they will apply to risk manage that position once it's on the books. Okay, let's first talk about cost. Like cost, basically the S&Ps and the US vol is the most liquid on the world. But that is really true actually in the short-dated part of the curve, so up to 1 year. After 1 year, actually, it becomes less true. The reason why actually is in Europe, exotic business is dominant. Meaning actually like a lot of our business actually is much longer dated. Meaning actually the axis that we'll have as a bank will be like on the long dated. So the price discovery actually on the long dated part of the curve in Europe actually is almost done because we price structured product on long dated, it's our bread and butter business. Meaning that for a client, the cost to trade long-dated option is lower in Europe than in the US. While at the opposite, on the short-dated trading S&P vanillas is like this. It's much cheaper to trade those. So that's one of the main difference. And in terms of execution, actually, we touched base on that in the panel and earlier during like our discussion, is given the fact that in the US they trade naked, us we trade tied on the option. That's one other difference that we have. Asia is in between because Asia actually still have like structured product and then hence you have like a term structure and trade that goes longer dated. But in terms of liquidity, I would say it's on the short dated it's US, Europe, and then Asia, while on the back end you'll have Europe the most liquid, then Asia and US like kind of like similar. Of course, for me, like the key takeaway for the panel is that the flow business is changing. It's changing. We all know where we are going to. We know where the end of the journey is. It's just how will we get there? And each bank has its own idea of how he will get there. But the only thing we know is that the market will be much more electronic in the future. At the end, maybe actually volatility will just be like an asset and will be like very commoditized as an asset, meaning actually it might trade like cash. You already see that with the VIX, for instance, like the VIX future actually traded like cash by some market participant. So actually the whole volatility market is shifting toward that. The whole flow is shifting toward that. It's just now, how do we get there? Is each bank has its own idea and how we'll get there, but that's a key takeaway. Flow is changing. Margins are reducing, and trading volatility is getting cheaper and cheaper to trade volatility.